In this video, we are going over my top 7 stock picks for 2020. I've done hours and hours of research so that you guys don't have to, and this is my list of 7 companies with huge growth potential. Some have dropped dramatically in the recent months and could shoot back up, and some have weathered the storm and should continue to do really well. Make sure to watch until the end to get my full analysis on each of these 7 companies, and you'll see why they can make you a lot of money in the long run. My last top stocks video from May of 2020 did extremely well, so I wanted to focus on a new set of companies for this video. Some of these stocks are more risky but have higher growth potential, and some are more stable but should see consistent gains. It's always smart to hold a diverse portfolio of stocks, so let's get started. The first stock on my list is US Bancorp, stock ticker USB. This is an American bank holding company that owns US Bank, which you guys probably have heard of. They're the 5th largest bank in the US. And first we'll jump straight into the stats and then we'll get into the news. So currently US Bancorp is trading at $35.56 with a 52-week low of $28.36 and a 52-week high of $61.11. Its current price is 25% higher than its 52-week low, but it is over 40% off from its all-time high. If we zoom out on the graph, we can see that there was a 40% price drop starting in late February, and since then it hasn't really recovered much. US Bancorp has a market cap of $53.56 billion with a PE ratio of 9.16, which is quite low, and an earnings per share of $3.88. Right now it has a very respectable dividend yield of 4.6%. Its forward PE ratio is 15.87, and it has a price to earnings growth ratio of 3.69. Their price to book ratio is a pretty low 1.21, and they currently have a profit margin of 30.8%. This is definitely a solid profit margin, and right now the return on equity is 12.24%, which is about average. To calculate the return on equity, you divide the net income by the shareholders' equity, and this is basically just a measure of financial performance. The higher the number, the better it is. It's always interesting to see what analysts have to say about these stocks. So on a scale of 1 being a strong buy and a 5 being a strong sell, right now US Bancorp is at a 2.7, meaning it's between a buy and a hold. The analyst's average price target right now is $41.47, which is 17% higher than its current price of $35.56. I think that this is a pretty attractive price for a very strong company like US Bancorp. Compared to other banks, US Bancorp normally trades at a lot higher when compared to its book value. This bank has a great track record, and the reason why the stock price is so low right now is due to the uncertainty of how Americans are doing with their financials. With this recession, a lot will ride on whether or not people can get their jobs back, as well as actually paying their bills on time. This will directly affect US Bancorp just due to the fact that they have a large amount of loans out. They actually don't have an investment banking division, which means they cannot take advantage of the really low prices in March and April and make some profits there. One interesting thing to note is that Warren Buffett actually has about $5 billion of US Bancorp shares in his portfolio. And in May, he sold about 1% of his holdings, which is basically nothing. As a company, over the next 6 months, they are planning on closing some of their underperforming branches, and they are trying to expand into more markets in the United States. They will also be focusing on increasing their digital banking technology. I noted this before, but they have a very high dividend of 4.6%, which does not seem to be going away anytime soon. This is a stock that was hit hard by the pandemic, and since then it has not yet recovered. While I do believe that any banking stock right now is a bit risky just due to the uncertainty of America's financial position, I do think that this could be a great buy, especially in the long term for a company with strong fundamentals like US Bancorp. Okay, next up on my list is Square, stock ticker SQ. This is a financial tech company that focuses on payment processing and merchant services. Right now, Square is trading at $81.08 per share with a 52-week low of $32.33 and a 52-week high of $87.25. As you've probably noted, their current price is 2.5 times higher than its 52-week low, and it's only about 8% lower than its all-time high. If we zoom out, we can see that there was a 50% drop in the first half of March, and since then it's shot back up like crazy to around $80 per share. It's as if the pandemic never happened. Square has a market cap of $35.6 billion and a PE ratio of 122.66. Yes, extremely high, so I know value investors will not touch the stock. Their current earnings per share is 66 cents. They are not paying out a dividend, and they have a forward PE ratio of an even higher 181.82. Their PEG ratio right now is 5.79, and their price to book ratio is 19.63, which is also very, very high. On the profit side, Square has a profit margin of 5.99% with a return on equity of 21.01%, which is quite good. Their current ratio is 2.19, which means that they have double the current current assets as current liabilities. And as far as what the analysts say, right now they're rated as a 2.5, meaning that it's between a buy and a hold. The average price target right now is $62.74, which is much lower than the current price of $81.08. Yes, the stock is definitely priced pretty high right now, but why is that? A lot of future growth is baked into this current price. Square's revenues were up 44% in the last year to $1.38 billion. One reason why it's grown so much is because gross payment volume has just increased a lot. As a result, their Q1 earnings definitely beat analysts' expectations. One reason why I like Square is because it has a moat, a competitive advantage over its competitors. They pretty much do everything, and this presents a lot of opportunity for growth. For example, their products are able to help sellers in almost every single way, and that presents an all-in-one solution that will keep customers loyal and happy. Another example of a strong business that they have is Cash App, and this is definitely one of those applications right now that is blowing up. Its gross profits are up about 120% year over year, and the revenues are up 200% to $527 million. With Square, you have to be a little bit careful just due to the high current valuation. Really, we have no idea if there's going to be another market downturn, but if there is, Square will definitely be affected. But I do think that this company is on the right track for huge growth, and that is why it can be a very good long-term buy. Third on my list is at&t, stock ticker T. I don't think at&t really needs an introduction, but right now they are a very popular 5G stock. Currently, at&t is trading at $30.86 with a 52-week low of $26.08 and a 52-week high of $39.70. Their current price is 18% higher than its 52-week low, but at the same time, it's about 25% under its high. If we zoom out, we can see that there's a big drop in the beginning of March, and then it remained near its low and hasn't really recovered since then. at&t has a market cap of $219.87 billion with a PE ratio of 15.67, which is relatively low, and an earnings per share of $1.97. Their dividend right now is at a very high 6.7%, which means that yes, dividend investors will love the stock. at&t has a forward PE ratio of 10.08. Their price to book ratio is 1.28, which is quite low and is a good thing. And they have a profit margin of 8.05%, which is a bit low. The return on equity is also quite low at 7.99%. And in terms of the financials, their current ratio is at 0.76, which is not the best. Based on what analysts say, right now at&t is at a 2.7, meaning that they are a hold. And the current price target average based on these analysts is $33.88, which is 10% higher than its current price of $30.86. So going back to the rather high dividend of 6.7%, a lot of people will question if they are able to actually pay this out. And in the news, the CEO has said that yes, they are comfortable paying out that dividend. at&t hit a high in 2016, so they're definitely not a trending stock or anything like that, but it is a solid company with a lot of good history. So in the news, obviously at&t made a big mistake buying DirecTV for $49 billion, and right now they have a huge long-term debt of about $140 billion, which they are continuing to pay off. Their Q1 revenue was up 0.2%, and its wireless service division is growing every single year. Another big plus is its expanding 5G network, which presents a lot of growth opportunity for the future. One thing that sets at&t apart is that it has a lot of cash right now, about $10 billion, and that definitely puts them in a strong financial position. Guys, at&t is not a rapid growth stock, but right now could be a good time to get in for that high dividend yield, as well as its future growth as a good 5G stock. I do believe that if you invest in at&t, you will get consistent returns in the long term. Next up on my list is Etsy, and Etsy is an e-commerce website where people can sell mostly handmade and vintage items. It's like eBay or Amazon, but with a more homey feel. Right now, Etsy is trading at $80.98 with a 52-week low of $29.95 and a 52-week high of $88.02. Their current price is an astonishing 2.7 times its 52-week low, but it is about 10% under its high. So we can definitely see that there was a 50% price drop in the first half of March, and then since then it's shot back up like crazy to its all-time highs. Right now, Etsy is relatively small with a market cap of $9.611 billion. This is a small business right now, but it is definitely growing fast. Their PE ratio is an astonishing 131.67, so obviously value investors will not like this. This is a very high number. Their earnings per share is currently 62 cents, and they don't have a dividend. Their forward PE ratio is 91.74, and their PEG ratio is 4.0 9.46. Their price to book ratio right now is very high at 21.61, and they have a profit margin of 8.76%, which is relatively low. Their return on equity is 18.58%, which is very solid, and the current ratio is 5.71, which is the highest on this list of companies. Right now, analysts do rate the stock as a 2, meaning that it's a buy. And the average price target right now is $61.06, which is 25% lower than the current price of $80.98. In quarter one, Etsy's revenue was up 34% to $228 million. A big part of this was all the people selling face masks on this platform. Their active seller count was also up 26.4% in a single quarter, which is just remarkable. Overall, Etsy is a platform that has built really close connections with its sellers. So that's why we shouldn't be as worried seeing these competitors come out, such as Facebook Shops. Etsy is currently investing in their search technology, as well as trying to offer free shipping on most of the products on their platform. And this has actually worked really well in customer loyalty and retention. Obviously, the huge increase in price, especially for a company like Etsy, shows how fast the e-commerce space is rebounding and growing. If you are willing to hold long term, then entering at a price like right now might not be so much of a concern. Quarter two could see more revenue growth at about 70 to 90% year over year. And in my opinion, this is still a relatively untapped market. And that is why I do think that Etsy could be a smart stock to invest in. Especially if we do see a dip sometime in June, then that could definitely be a good time to buy. Number 5 on my list is Alibaba, stock ticker BABA. This is an e-com leader in China that also owns AliExpress, and they've also diversified into many exciting fields. Globally, 960 million people use their platform, so they are a huge company. Right now, Alibaba is trading at $207.39 with a 52-week low of $148.85 and a 52-week high of $231.14. Their current price is 37% higher than its 52-week low, but it is about 10% lower than its high. If we zoom out on the chart, we can see that their share price has been steadily increasing starting in October of 2019. And since then, we've seen a pretty significant drop in February and March, and it's mostly recovered by now. Like I said, Alibaba is a huge company with a market cap of $556.8 billion. Their PE ratio is a little bit high right now at 58.31, and they have an earnings per share of $3.50. Their forward PE ratio is 24.15, and their PEG ratio is 1.1, which means that we expect a lot of growth in the next 5 years. Their current price to book ratio is 5.11, and they have a very good profit margin of 35.21%. Right now, their return on equity is a very good 23.01%. And looking at their financials, their current ratio right now is 1.75, which is very healthy. Analysts say that Alibaba is a 1.6, so it's between a medium and a strong buy. And the price target average right now is $256.50, which is 24% higher than its current price of $207.39. The biggest telltale sign of growth for this Chinese company is that even in Q1, when China was hit extremely hard by the pandemic, revenue still increased 22% year over year. Its cloud computing division saw increases of 58% year over year. And its e-commerce business, which makes up the bulk of Alibaba, was up 19%. So one thing you have to be careful with is right now there are some political tensions between the US and China. And that does mean that there is a possibility that Alibaba could be delisted from the New York Stock Exchange. I think that the negative sentiment thrown at these Chinese companies has made Alibaba's share price grow less than it could have. And that's another reason why I think this can be an attractive price to get in on the stock. There's a lot of potential growth for e-commerce as well as cloud computing in China. And also we should expect to see a lot of growth in the Chinese economy over the next 15 to 30 years. And that is why I think Alibaba could be a great stock to invest in June of 2020. Next up on my list is Visa, stock ticker V. Visa is a global payments technology company, and you see their name on pretty much every single credit card out there. Right now, Visa is trading at $195.24 with a 52-week low of $133.93 and a 52-week high of $214.17. Their current price is 45% higher than its 52-week low and just 9% under its 52-week high. If we zoom out on their chart, we can see that they reached a high in mid-February, and then we saw a drastic drop of about 37%, and then since then it's rebounded back to around $195. Visa, of course, is a huge company with a market cap of $428.86 billion. Their PE ratio is 35.14, and they have an earnings per share of $5.56. They do pay out a dividend, but right now it is pretty low at 0.62%. Their forward PE ratio is 38.8, 3.31, and their PEG ratio is 2.82. Visa's current price to book ratio is 14.13, which is a bit high, and its profit margin is 52.26%, which is actually very good. Visa's return on equity is a very high 36.25%. And on the financial side, we can see that Visa's current ratio is 1.25, which is solid. Analysts say that Visa is at a 1.8, meaning that it's a medium buy. And the current price target average is $200.50, which is 2.7% higher than its current price of $195.24. Visa has been one of the best performing large cap companies over the last decade. They took a huge hit due to the pandemic uncertainties, but right now they're pretty much almost back to an all-time high. Looking at Q2 numbers, Visa saw an earnings per share of $1.39, which was above expectations. This good performance was due to huge increases in payment volumes. Visa's processed transactions were up 7% from the same time last year, up to $34.9 billion. In the news, Visa recently acquired financial tech startup Plaid for about $5 billion cash. And this shows that Visa is adapting to the times and growing into relevant spaces. Overall, Visa is in a great position as e-commerce as an industry grows and grows and grows. More people are buying things online, which means that they can't use cash. If you look at the history, you can see that Visa has grown so much over the last decade, and it seems like they have no plans on stopping. I believe that this is a great long-term buy, which will make you money over the long term. Okay, number 7 on my list is Berkshire Hathaway, stock ticker BRK-B. This is actually the 6th largest publicly traded company in the US, and it's run by the famous Warren Buffett, who I talk about all the time in my stock videos. Before I go over the numbers, I just want to say that I still think Warren Buffett knows what he's doing, despite the relatively poor performance in the last quarter. Right now, Berkshire Hathaway is trading at $185.58, with a 52-week low of $159.50 and a 52-week high of $231.61. Their current price is 16% higher than its 52-week low, but it is still quite a bit down from its high, to be exact about 20%. If we zoom out on the chart, we can see that there was a huge drop in February. It recovered a little bit, then it went back down, and then recently it went back up. Berkshire Hathaway has a market cap of $450.5 billion with a forward PE ratio of 19.25. They do not pay a dividend, and their price to book ratio right now is 1.18, which is quite low. Berkshire's profit margin is a very low 3.9%, and their return on equity is also very low at 2.77%. However, financially, they are very strong. Their current ratio is currently at 2, and they also have an insane amount of cash on hand. Analysts say that this is a 2.2, which means it is a buy, and its current price target average is $230, which is much higher than its current price of $185.58, 24% higher to be exact. This could be a solid clue that there is some current upside in the stock. Right now, the stock price is not fully rebounded, which means that right now it could be a good time to get in. The reason why I like the stock is because it's sort of like an index fund. When you buy the stock, it's pretty much like investing in whatever Warren Buffett is investing in. Now, in the news, it's a little bit confusing because we would have expected Warren Buffett to actually pick up some stocks in March and April when the prices were super low, but he's actually sold more stocks than he bought. This means that they're sitting on a huge pile of cash of about probably $150 to $160 billion. The good thing about this is that they are well positioned if there is a second wave of this pandemic, or if the economy hits new lows. We never know, and it certainly is possible. It seems like Warren Buffett is bullish on the current state of the US economy. Yes, we've seen lots of critics be quite vocal about what they think about Warren Buffett's performance, but for me it seems like he has at least something up his sleeve. I definitely see some upside in the share price, and right now could be a good time to pick up some shares at a significant discount. So yeah, you guys, those are my 7 top stock picks for June of 2020. As always, make sure to do your own due diligence before investing in any type of stock. I am not a financial advisor, and you should just take my video as entertainment purposes. Use it as sort of like a comprehensive guide of these 7 companies, and then take that and do your own more detailed research by yourself. I highly recommend not putting all of your money into 1 or 2 stocks. You want to have a more diversified portfolio, especially in a time like this. Guys, if you have not signed up for WeBull yet, make sure to do so and get your 2 free stocks worth up to $1,650 when you deposit just $100 into your account. I use WeBull myself. It's an extremely powerful platform, and it's also free to use. As always, if you guys got some value out of this video, make sure to hit that like button and also subscribe to my channel. These videos take a long time to make, so your support means a lot to me. So that's it for today. Thank you so much, and I'll see you guys in the next video. Peace.